The markets have not been dealing with the tariffs very well, as I'm sure you have noticed. Today we're going to be joined, as always on Fridays, by our good friend and colleague, Professor Mark Guthner of Rutgers. We're going to talk about what's going on in the markets and what we might do about it. Today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Interest and Office Hours with Professor Mark Guthner. Mark, how are you?
Well, hopefully we'll get to talk about some of the issues and maybe bring a little light on what's going on. There's a big emotional response here that maybe is not quite warranted.
So, right before we went live, one of the remarks I made, so we were in the midst of a live stream. Brian Stutland was on Wednesday when President Trump held his presser in the Rose Garden and these tariffs were announced. So we didn't have much of an opportunity on Wednesday afternoon to look at these things more closely, to examine what numbers were chosen, why and how. But the thing that I had been sharing with you that I think was a political miscalculation by the administration that is probably not the best thing that they could have done is that they have attempted, in fairness, they've attempted to calculate what they believe to be the net tariffs that the United States is subject to as a part of their calculus, in addition to looking at the respective trade deficits with each country to identify what they thought the appropriate level of tariff should be. And the miscalculation I think that they made that I particularly dislike is that what they should have done was looked only at the published tariff rates, even if there are trade barriers that actually restrict U.S. exports to the respective trading counterparty, because what it's done is it has provided fodder and it has clouded the issue. So if they had just simply said, these are the tariffs that we are facing, these are the tariffs we are imposing, you will notice that some are closer to what we face, others are not, and started with that, because now we have a lot of opponents of the president and their policy positions coming out and saying, well, that's not exactly what the tariff is, and why is VAT being included in this, and why are other things? What do you make of all of that? Do you think this, and this is really, I guess, more of a political question, neither you nor I are political scientists or international relations experts, although both of us may have studied it a little bit. What do you think?
Well, they're certainly clouding the issue, and if you're trying to do something this big, you've got to keep your message as simple as possible. You don't want the population, whoever is analyzing what you're saying, having to spend hours trying to figure out, well, what's the math going on behind this? Like, what's the rationale? Because of course people aren't going to do that. They're going to say, well, I thought you had this reciprocal thing, and reciprocal to me sounds like if they charge me 50, I'm going to charge you 50. Then you move on. That's a simple message. I think that's what most people thought. Now, when we were talking about this before, I was wondering if he's got a team of academic economists back there toiling with, stacks of paper and complex equations and all this kind of stuff, and making life just too complicated, because that's what economists like to do. Being a free market economist, I'd like to think of things very simply and not in mathematical terms, but in terms of incentives.
So it's interesting because, in fact, they actually did publish the mathematical formula that they said, and I'm actually going to try to find this right now because I had it. See if I can find this. Let me see if I can find this thing. I think I have it here. And actually, perhaps once I find it, we'll be able to share it with others. Here's a So I have a big table. Okay, that's the big table of the respective tariffs. Ah, yes. Okay. So let me. I'm going to try to snip this and blow it up and see if I can show this now. Let me see. I should have had this queued up. I guess I didn't know
That's all right.
exactly where we were
One of
going
the
to
things that
take this
does
conversation going, but
go into these calculations, I would guess, is not only the tariffs of stuff coming in, but the subsidies of product they want to send out.
yeah. So this is. I actually had to just. I was not able to bring it up the way I had wanted to, but this is the formula right here. That they were stating they were using. And if you go to this link, which is ustr.gov, and then you can probably do a search in the upper right hand corner, and you can go to reciprocal tariff calculations. There's a little bit of a write up here,
Mm-hmm.
but this actually describes the basic approach, right? So you can see that here. That's the formula. And I think this speaks a little bit to what you were talking about. Now, one of the nuances that they tried to capture in this that I think was inadvisable in terms of messaging was that they were trying to calculate, these sort of effective tariffs,
Yeah.
right? And that just creates a lot of noise. And again, as I previously stated, if you're not going to match the number that basically what we in the industry in terms of trading call the card rate. So the card rate is the published rate.
Yeah.
Then there are other rates that could be going on, like you could get rebates and this and that. So this is kind of a common thing. It's sort of like the sticker price. If we had just simply used the published tariff rates for each respective counterparty and compared it to that, people wouldn't be forced to dig into all of this. That's the first issue that I take. The second issue that I take is that it's my understanding that the administration didn't have conversations with many of these trading counterparties ahead of time. If only to say, this is the rate that you charge us, and understand we're going to be having a presser on April 2nd, and we said we were going to, instate reciprocal tariffs, which means that we're probably going to be charging you something that looks like what you charge us, or, some derivative thereof. Do you want to talk about it first, or do you have anything to say about it? Or is it just going to be no comment? So I think, the comparison I made was that I was just saying that a lot of wars, a lot of fights break out when one actor decides to do something unilaterally with the expectation that the counterparty, the other actor, is going to do nothing or back down.
Mm-hmm.
Right? So, and to anybody who thinks, well, we're the bigger player, and so they should, I would ask the following question: if you've ever been in a fight and you got punched in the face, how often did you immediately say, wait, let's talk about this and see if we can't reach some kind of an understanding, rather than immediately sort of engaging in the brawl,
Yeah.
and trying to defend yourself? Now, obviously, one hopes that policymakers are going to be rational actors, but they also have other things that are going on. Among those are the fact that it could be politically unsavory to be seen as kowtowing to President Trump.
Yep.
So, anyway, I wanted to leave it there. You had a couple slides, I think, that you wanted to show. Do you want to?
Yeah. So
share
let's
those with
put
us?
up the Buffett indicator first. I like to go back to this because let's see if it comes on up. There it is. The Buffett indicator is comparing the market cap of stocks to the economy. So it takes the market cap divided by the size of the economy, get a value. And we can see that that's way, two standard deviations above historic levels. And so I've always thought that the market has been overvalued, and things stay overvalued until there's a catalyst um, to make people change direction. Um, it's sort of like in Japan. Japan was the most expensive market in the 1980s. It was something like 60% of the IFA index. The stocks were wildly overpriced, and it took some kind of change, some kind of catalyst, which knocked it down. And now stocks in Japan are not even as high as they were 40 years ago. If you bought at the top, you're still underwater. People looking for a catalyst for why now Japanese stocks are actually very inexpensive. You can buy a lot of Japanese stocks well below book value. Here we are in the US, we've got egads of tech stocks trading at more than 10 times revenue. Um,
Mm-hmm.
so there's a lot of promise of good things to happen in the future. At least that's what people are betting on. So this tells us that the equity markets are overpriced by a historical perspective. And I believe in mean reversion, which means we're going to head back to the average at some point. But what's the catalyst? And I think what's turning out to be the catalyst now is this tariff thing that's getting people to look at value a little bit more. And as stocks start to go down, yeah, we're going to start to see the momentum players be net sellers versus being net buyers as they've been, for a couple of decades.
So there's two things working here. I just want to address your comment. The first is that if we take a look at the average forward multiple for the S&P generally, going back to 1990, right? So actually, that's probably a good time to go back to because that's very close to the time that Japanese stocks were at their peak valuation. So
In 1990.
35 years ago. So the average forward multiple for the S&P, and we can show this on my screen if we want, so people can get a look at it as well, is about 17.9 times forward earnings estimates.
Mm-hmm.
So that's the average of the estimates. In this case, it's the Bloomberg forward estimates. So for anybody who's interested, that's this blocky yellow line right here. So I'm just going to draw a line which gives us a sense of where that is relative to where we are. Okay, so like I said, about 17.9. So that's going to be right in here. Okay,
Mm-hmm.
so that would represent. Now this is a range. We're probably closer as of the prices right now. Maybe we're 20 times the forward earnings estimates. But, that still suggests that we're 12% above mean valuation. That's the first thing I would say. Second thing I would say is I would like people to, and I'm going to get rid of that line so we can clean things up a little bit. The next two lines that we are showing here are the top line growth. So this is the revenue and sales growth for the S&P, essentially on a per share basis
Mm-hmm.
over that same period of time. And that has grown at a compound annual growth rate of about 4.5%. So faster than GDP. This is one of the reasons why I frequently will say when we hold these live streams, if you're looking to buy a stock because you think it's growing, it should grow at least as fast as this, if not faster.
Mm-hmm.
Because it isn't really, if it's not, it doesn't have to grow as fast as the economy. It has to grow as fast as stocks generally. And the best stocks generally outpace GDP. And it makes sense because it's a basket of winners, right? The losers fall out, and the newest, greatest thing comes in.
But remember, that number is a nominal number. You got to compare that to nominal GDP, not real.
Right. But what I'm saying is that that is greater than nominal.
Oh, is that right? That nominal GDP was not faster than 4.5% since then?
No, I don't think so, and it certainly isn't faster than the earnings growth, which is 7.2.
Oh, okay.
And by the way, these numbers have accelerated considerably in more recent years.
Yes, they
It's
have.
more like 6.5% and 10.
Yeah, you can see how much steeper it is there. at the end.
Yeah, you can see this, right? So
Yeah.
part of that is going to be a function of the fact that this is not a logarithmic chart, but the fact is that S&P revenues have been growing faster than than GDP over the last couple of years, basically since the pandemic trough, which also makes sense because there's a big fall off first, but earnings too. And what concerns me here a little bit is that number one, you can in a down market, you can overshoot the mean.
Yeah.
You know, you can say we expect that the multiple is going to revert to the mean, but markets overshoot all the time. They get, you know, if it's undervalued, they have a tendency to overshoot and become overvalued. And when they're overvalued and they're going to get back to a mean valuation, they tend to overshoot and get undervalued. But the other thing that concerns me here is that we have not had a meaningful change in U.S. Trade tariff policy in 30 years. So what this means is that to the extent that the current global framework may have been taken advantage of by some U.S. companies, Nike increasingly manufacturing overseas. There's a lot of companies in the United States that sell their goods here, U.S.-based companies, and manufacture things abroad, more so than was true 30 some odd years ago.
Mm-hmm.
And what concerns me is that we have seen significant margin expansion. So profit margins have grown for the S&P. Now, part of that is tech, right? Software companies operate the biggest and best tend to operate at very attractive margins. NVIDIA, we've never seen margins like this for any company that I can remember.
No.
70+% margins is just an astonishing thing. So my question now is, do you believe, Mark, that we're going to aggravating a potential down move would be not only a reversion to mean valuations, but an overshoot? And secondly, that the forward earnings estimates are too ambitious in this new environment. What do you think?
I don't know that we're going to overshoot. I would say on the downside, to overshoot to the downside, I would be looking for a World War III scenario. And so I'm not looking for that, to be clear. But that's would take it down below that indicator that I had, that Buffett indicator I had, which is like a 40% drop in stocks to get down to
From here?
average.
From peak or from here?
From here, yeah. So on that Buffett indicator, so if we get back down to the zero, because we're 2 standard deviations above, I think that, I don't know exactly, I didn't do the math, but 40 something percent. If it went below that, then there would be something entirely out of my imagination of things getting that cheap. So I'm not expecting that. But we could have a regular correction of 20 to 40%, and the economy would still be okay, and that kind of thing. So we're working off some of this froth. The Fed has printed so much money. An interesting chart that we don't have here is any of the viewers want to watch, go on to some charting service they might have, take the Russell 5000 or their S&P 500 and divide it by M2. And so if you make an adjustment for money supply, stocks are up, but they're not wildly up like we're seeing. A certain amount of that has to do with money printing. And since the money printing has been more aggressive since the great financial crisis, it's not surprising that money is reflected in higher asset prices.
Yeah, so now I'm going to just quickly also go back to about 1990 here. And yeah, so this is M2.
Yeah.
Right here.
We've had that big growth. And so instead of whatever the average was, 10, 11% per year from that time period, adjusted for M2, it's like, 3% or something. So part of that run up, and that's where this idea of this Fed put comes from, that whenever the stock market starts to head down, the Fed trying to keep the economy going, well, loosen money supply, and that money, some of that money finds its way uh, into asset prices, stocks and bonds, and puffs them right up.
So to put things in perspective, folks, if you're trying to figure this out, just going back to this chart, M2 was about 3.3 trillion in 1990, and it peaked at about 22 trillion recently.
yeah,
Right? So if we're just trying to work this out, so that's 22, so that's a 6.6 fold increase. So you basically take it times 6.6. So now we can just take a quick peek, and we could look at revenues and stuff like that if we wanted to. But so the S&P was about, it's actually grown much less. Although, in one of the things that I would point out is that it's not perfect to sort of do that kind of divisor math, but it is indicative, as you point out, that the money supply has actually grown faster than the S&P level.
yeah.
Right?
That drives up share prices. That makes people be very confident and very happy to overpay for stocks. The whole issue now around passive investing, instead of being stock pickers and doing your due diligence and figuring out what something's worth, trying to buy that cheap stock to add to your portfolio. Now something like 60% of the money going into the market is going into index funds. And so you're buying the good, the bad, and the ugly, and people are not asking the value question anymore. So this is the kind of psychology that allows, in behavior, that allows equity prices to get very expensive relative to the size of the economy. And so that has, to me, a word of caution. And that process would just continue until there's something that breaks people's psychology. And it appears to be at this point in time that it's this tariff confusion that is causing that to happen.
So, it's interesting. Now, I don't know whether it was JP Morgan, but there was news out that from one of the brokerage platforms that said that retail investors have been buying the dip fairly aggressively. Institutional investors have not. And when I say buying it aggressively, what that suggests is that's not just the strict passive investment. That's not, I got my paycheck. My paycheck was $2,500, so I put $250 into equities because that's, I'm saving 10% of what I make. This is proactive decisions. Equities are cheap. I want to buy more. Buy the dips.
Yeah.
That philosophy. And by the way, in general, this is an idea that I support because saving is a good idea, and equity markets generally rise over time. And if you can buy it at a cheaper price, your margin of safety is going to be greater. So this is not a bad process. But as a day trade, one does wonder. I have up on my screen right now a table, and what this is are stocks that all have PEG ratios of greater than one, at least based on less than one, at least based on forward earnings estimates. And you can see by the peak here, there's Sentinel 1, which has a PE of, forward PE ratio of whatever, 83.7. That suggests that the market thinks it's a hyper growth. So let's start pulling some of that out and eliminate companies that have PE ratios of, say, greater than 40. You start getting into, look at this. I mean, NVIDIA is trading 21 times trailing now. Is that possible?
Yeah.
That's, starting to get cheap. Vistra is trading 16.4 times. This was a high-flying stock. So there are stocks that I think people can start taking a look at where valuations are getting more interesting. Newmont, this is an interesting one because we did see gold, which has obviously been almost on an unmitigated tear.
Yeah.
Suddenly, so I happen to observe, now I've said this on these live streams more than once, I get a little worried when you see a stock open higher, trade to new all-time highs, and then close lower. And it did that a couple days ago over here. But then actually the next day it traded okay. So it wasn't, but the fact that that happened, that's not a good recipe. So that's what I'm talking about right here.
Yeah.
So this was a day we closed here, we opened here, traded to new all-time highs. It has not gotten back there, and it ended up over the rest of that day trading sharply lower. And that's those types of things get me a little bit concerned. We had another day. That's a warning sign. It seems like a lot of the froth is now coming out of it. This is only 10 trading days. We're still basically flat. So if somebody's saying, "Oh, I've been long gold, but I don't want to sell it because it's not at its all-time highs where it was just a couple of days ago," I wouldn't worry about that, because you got to put this into the longer-term perspective. Gold was on the list of things that I thought was thematically important for the last couple of years. And if you're selling it here after this sharp drop off because you're saying, I think it's time for me to take some profits, or at least pair some profits, because think about this. This goes to the rebalancing question. If I had 10% in gold at the beginning 2 years ago, right?
Yeah.
What's happened now in this most recent year is that allocation to gold has become outsized. Equities dropped and gold has continued to rise. So if you just simply rebalance and say, look, I want to hold 10% of my portfolio in gold, sell it down to 10 and reapply that to some other assets that have become cheaper, no?
Yeah, well, that's how pension funds look at the asset allocation situation, that they have a target asset allocation. One asset class is inevitably going to outperform the other. And so you're naturally kind of buying high and selling low, or at least selling relatively high and buying relatively low by doing that. So it's a very common practice with big institutional money.
So I wanted to just, so we have a question here. I'm going to put it up on the screen.
Okay.
From Monday Morning Quarterback. Monday Morning Quarterback says, assuming no walking back tariffs over the weekend, how much market risk do you think we face on Monday? Number one, do you think Trump would walk them back over the weekend?
No.
I don't either.
I don't. It's just not in his makeup to do that at this stage of the game. I think people are a little overreacting to a few thousand Dow points. What is the peak to trough drop now? And let's say the Dow or the S&P, is it like 10%?
It's a little bit more than that. So the NASDAQ is formally now in a bear market, and the Russell too, I believe, from a peak to trough perspective.
If you look at historically, we get a 10% drawdown every 2 years.
Yeah. So the S&P we are at 51. I'm going to use 5140. 5140. We're down, 16%.
Okay.
Peak to troughs.
Okay.
I think so a couple things. I think, yes, we get to formal bear market territory.
Yeah.
I think it's hard to say we don't. I will tell all of you who are watching, for what it's worth, that my good friend and colleague Carter Worth, he's targeting 48.50. He doesn't really see how we avoid getting there. Mm-hmm. I will tell you that mean valuation of forward earnings multiples is about 4,500 in the S&P. That's 17.9 times forward. So I see some potential further downside. And I agree with you. I don't think Trump is not facing re-election. He's not they was it in the movie Clear and Present Danger, I think, with Harrison Ford. What does every first term president want? A second term? Well, this is his second term.
Yeah.
He's going to be 82 years old when it ends. He's not going to run again. And I encourage people to go, I don't know if we can find it. It would be funny if we could. There's an interesting interview of Donald Trump on Oprah Winfrey's show. I think it was in the 1990s, actually. Howard Lutnick shared it on X recently.
Okay.
In that interview, he spent a lot of time talking about what he thought were grossly unfair trade practices that the United States faced with its trade partners. And Oprah said, "This sounds like political presidential aspiration kind of talk. Would you ever
Yeah.
consider running?" And he said, "No, I don't think so. But,
Yeah.
hopefully people are smart about this and they do something good about it." Oh, actually, no. You know what? This had to have been, now that I think about this, this has to have been the late 80s that came out. And the reason I know that is because her next question was, who do you think is going to win the presidential race? And the names he mentioned were Jesse Jackson, Michael Dukakis, and George Herbert Walker Bush. That would have been 1988.
Yeah.
So actually, that video has to date all the way back to 1988 then. But the reason I point people to that is that this has been a bugaboo of the president's for closing on 40 years.
Yeah.
Which is the chances that now that he's actually starting to say, I'm going to fix this thing that's been driving me nuts for the better part of half a century, the idea that he's going to back off of this quickly, that seems unlikely for him. But there are other people around him. Besant's a smart guy, and Besant might be looking at what's going on in the stock market and saying, this is going to have a big impact on the wealth effect. Do you want to talk a little bit about the wealth effect and how that could affect things?
Yeah, the wealth effect is this idea that when stock prices go up, people feel, or the price of their house goes up, that they feel more wealthy and they feel like they can go spend more money. It's a Keynesian concept that people have an idea of or some kind of wealth goal in their mind and a spending goal that they would like to have. And so if they have more wealth, they're willing to spend some of that to on whatever it is that they want to enjoy.
I thought I would also just take us to this chart here. This is a chart of the 10-year. What are 10-year rates telling us? We're now trading with a 3 handle on the 10-year.
Yeah.
That doesn't smell good in my world when you see a 70 basis point rapid drop in the 10-year in the absence of some news, for example, that inflation plummeted. So if people were expecting a 3% inflation print and you got an 80 basis point print,
Mm-hmm.
instead, like it was just way off. I could see something like this. This is a very sharp move.
Yeah, there's a couple things there. One is some of this could simply be a flight to quality or flight to safety. If you're selling your stocks, you got to put your money someplace, and so people might be allocating away from stocks and into bonds, and that drives the interest rate down a little bit. Expectations theory would suggest that either they expect lower inflation or lower economic growth, or perhaps even a recession. I have been of the view that the government's going to announce numbers that are going to be consistent with a recessions or negative real GDP growth. And the reason why I say that is they're cutting spending, and they're doing that, at least they're trying to do that quite rapidly. So if GDP is equal to government spending plus consumption plus investment minus or plus net exports, if you're taking down G, that's going to lower GDP, and I would not be surprised that the GDP number comes in negative. On the political front that you're talking about with reelection and so on, I think that one of the issues might be that he only has 2 years. That what he needs to get done, he's got to get done before the midterm elections, because if he loses the House or Senate, they're just going to tie him up and duct tape for the final 2 years, and not much is going to happen. So that could be one of the reasons why they're pushing so hard on this factor.
Let me ask you two other questions. So a benefit of lower interest rates, there's a couple benefits, right? So one of the benefits of lower interest rates is that it will mitigate to a degree one of the things that we've talked about on this live stream more than once, which is the interest rate expense bomb. That is that this massive slug of U.S. debt that has to be refinanced that was issued under Yellen and Biden that carries a very low average weighted coupon. There's 9 trillion this year at less than 1%, 15.5 trillion over the course of this year, 26 and 27, at an average weighted coupon of 2.78%. We're now only 80 basis points above that in the 2-year. Not that I want to see us issuing tons and tons of 2-year paper like they did, but this is kind of where we are. So we're basically not even, we're back actually to the mid 2022 short-term rate hiking cycle. Not at the end of it, but I guess here's my question, twofold. I view this tariff thing as at the third. I think this is probably the third largest geopolitical event and market event to take place since I've entered the business. I think the great financial crisis was right up there, obviously, because we had, the potential for a lot of the world's major banks to be, to go under. That was obviously a catastrophic potential event. So that was certainly one of them. And the pandemic was obviously massive in terms of the global economy. We shut the economy down, which is also unprecedented. But I don't know of any two events other than those that come close to the potential scale of this one. We haven't, you and I, in our professional careers, and between us, we've got, 70 years in the business? Have you seen anything that's as meaningful as this? Or do you have a proxy from your international experience that you would compare this to?
I do not, but they're rearranging the way international trade works, and this idea that we can maximize corporate profits and individuals' well-being by lower prices. Now, if we look at after World War II, Europe's in tatters, Asia's in tatters. Those places needed a lot of help to get back on their feet. And so I think it made perfect sense for decades to provide them with advantages so that they can get back in the swing of things. And that's good for everybody. It's good for the people that live there, good for people in the U.S. But then we had this big move afoot to move to offshore everything in the United States. So we went from helping out those businesses grow to tons of U.S. businesses move their manufacturing from the U.S. Either into Latin America, Mexico, or Asia. And I think, one of the things that I keep reading, and I wasn't aware of this until it was repeated to me about 3 or 4 times, that is something like General Motors manufactures 40-50% of its product overseas and then turns around and sells it here in the U.S. And then the numbers they quoted was the UAW worker makes $27 an hour plus benefits. And the folks down in Mexico make about $2.50 an hour. And of course, if you're facing that kind of differential, there's a huge economic tug to pick things up from here and send them down there, and that's helped us keep prices down here. Yeah, for sure. But it's also cost tons of jobs, and the rub here, I think, is a political one, in that the people that benefit the most are the people on the two coasts, where it's much more of a service economy. Whereas in the center of the country was all the manufacturing was taking place, and farming. And that's the stuff that got kind of hollowed out. And I think that's why you see different attitudes by folks in the middle of the country versus the folks on the two coasts.
Yeah, somebody reached out to me today. I'm going to see if I'm going to read this because it occurred to me, I thought it captured the coastal sort of elitism and perception of manufacturing. And then I'll just read this, and I won't bother to share who sent it to me. The idea that Trump wants to bring back manufacturing so Americans can work in shoe factories or the such is arrogant and ignorant. Meanwhile, it's all just a fantasy that these companies will actually do this. Markets going down in serious chaos, insanity. Hopefully, the Senate finally stands up and reins this craziness in. Doubt it, certainly not yet. And I responded, I might as well even say how I responded to that tweet by saying, he wants auto factories, chips, and robotics factories. And we should all want that. It's also a national security issue. Imagine if every critical piece of technology is made in China. Who then will work for who? That was my response to that message. But obviously, auto workers want more auto working jobs. The UAW wants them, and there's plenty of people who want them.
Yep.
And they want those jobs protected such that you make a good living wage doing it. I mean, those types of manufacturing jobs were important. I'm not talking about people, maybe somebody does not want to glue a rubber sole on a Nike sneaker. But there's a big difference between that and assembling a Chevy truck.
Well, I would also go on
from a
to say
technology
that
perspective.
I would also go on to say that who is this person to make that decision for another person? Maybe there's somebody that does want to do that lives here in the U.S. I don't know, but I don't think it makes a lot of sense to speak for somebody else whom you've never met.
Yeah, well, this is somebody who has a JD LLM in securities law, so very, very well educated, top school type of an individual. Of course, it's very difficult for them to imagine. Let me just so
I'm going to toss in another twist to this manufacturing thing. Is
Mhm.
we really do need to bring manufacturing back. Listen, I'm a biased guy. I have a mechanical engineering degree. I worked in
Mhm.
aerospace and construction when I got out of engineering school for a while, and really enjoyed making things. I still like to tinker and make things now. But one of the things that's going to happen as robotics um, um, get bigger and bigger inside the factory is labor is not going to be, the labor wage is not going to be the deciding factor. It's going to be expertise. So we've got to
Mhm.
bring manufacturing back into this country so that we have the robotics expertise to manufacture products here. Otherwise, we're helping everybody else in the world develop that robotics technology, and the products will be built overseas. And one of the reasons that allows us to run huge trade deficits is that we have the world's reserve currency. We print a pile of it, and then the government spends that money into the economy, and a bunch of it ends up overseas. Um, that's not going to last forever if we have this attitude of we'll never make anything. We'll buy cars and we'll send you pieces of paper. Someday, we're not going to be able to do that.
I'd like to make that's a great point, and I wanted to point something out. So anybody who hasn't read it, Warren Buffett wrote an article that got published in Fortune in 2003 about the trade deficit and that we needed to do something about it. And it was an issue he'd brought up actually several times before. If you go to the Berkshire Hathaway website, you can find that article. I encourage folks to read it. It's chewy for a magazine article, goes on for several dense pages. But the point he was making in that article was that you have to finance trade deficits somehow. In other words, when we buy more than we sell, that difference has to be paid for in some way. And the way it is traditionally paid for is that there is a net foreign investment that takes place. They either are buying debt, we essentially are issuing debt and they're buying it from us,
Mhm.
or we sell assets. So that could be stocks, real estate, and all of that. The way he described it is that it's as if you're selling off little bits of the farm all the time to pay for the things you consume. And at the time that he wrote that article in 2003, the aggregate net foreign ownership that had resulted from our trade imbalance was 2.5 trillion. You know what it is now?
No guess.
18 trillion.
Yeah.
Of course, I mean, one would imagine it would need to be something like that because we run about $1 trillion trade deficit, and it's been going on for a couple decades.
Yeah.
So that makes good sense. Now, I'd like people to think about this. As of the end of February, the Magnificent Seven, that's Apple, Microsoft, Alphabet, NVIDIA, Amazon, and Meta combined, represented 30% of the then $60 trillion value of U.S. publicly traded equities. That's 18 trillion.
Mm-hmm.
Effectively, then, our trade deficit means that foreigners now own the equivalent of the entire Mag 7 in U.S. assets. Now, it's not the Mag 7 specifically that they own. They own U.S. real estate. They own U.S. debt. They own U.S. equities. You know, all of that kind of stuff. But that's essentially what we're doing, is we're selling off a little piece of the farm. The other thing is, and I think this is an important one, and the reason why I think we need fair trade policy is that from a national security issue, we cannot live in a place where we rely 100% on places like China to make every bit of technology upon which we rely. That's, you know, there are risks associated with that. People are worried about TikTok, but they're not worried that we might one day, every single car depends on Chinese technology. Every single phone depends on Chinese technology. Every computer screen, television, all depend on stuff that's made in China. I mean, how could we think that TikTok is a threat and not think that these other things are?
And don't forget medicine. So we invent the medicines here, and we prove them up and find that they are, they're effective. And then the manufacturing of those medicines are done overseas.
So we're getting asked by Spicy Barbecue, appropriately enough. So Spicy Barbecue Tasty is asking us about Cava Group. So somehow someone with a handle like Spicy Barbecue Tasty should be asking us about a food business, a restaurant business, Cava Group. You have any thoughts about Cava Group?
I do not.
Quite sharply.
It's not in my circle of competence, as they say.
Yeah, so one of the things that's interesting about these businesses from my perspective, it's down 50%. I'm just using round numbers if you're looking at my screens. It's down about 50%. Obviously, the all-time high was substantially higher and the lows here, but I'm just, it's been cut in half, effectively. One way to think about this is that, oh, well, they don't have as much exposure to this. I will say it is still a relatively high multiple business. I think they're trading at 100 times forward.
Wow.
Yeah, so full year 2026 numbers, 70 cents a share for the full year. And it's trading 74, 75 bucks-ish, so it's actually more than 100 times forward earnings.
Mm-hmm.
And it's got top line growth of 20%. I mean, obviously, it's a better investment now than it was a few months ago, much cheaper, but it's far from cheap.
Yeah.
And here's something that I actually would be more concerned about is that I would really like to see folks investing in businesses that have really comfortable and consistent free cash flow growth, because I think that could moderate somewhat. In other words, if things turn south, even rosy forecasts are not going to be meetable. So if you have, in this case, an $8.6 billion business and it's getting $80-90 million in free cash flow, that's the forecast. It's never achieved it.
Yeah.
That's not a huge number. There are businesses that are getting, where you're seeing free cash flow yields of 10% or more. And that's just a safer, more stable place to be. And I make this point that if you're going to try to pick bottoms, if you have a levered business, this is not a hugely levered business, but if you have businesses that are economically sensitive and where cash flow could turn negative, and this cash flow was negative in 2023, but you have a situation where cash flow could turn negative and you're uncertain, it's a more speculative place to start picking stocks, I think. What are your thoughts?
I think that's about right. I don't have any names off the top of my head. although oil and gas seems to be a sector that the world hates, and I own a little bit of
Mm,
Apache. I sold some 20 strike puts on that a month ago, and I just got elected overnight. Those puts
mm-hmm.
expire. I think they trade at 8 times, 7 times earnings. Um, that whole sector looks super cheap, and since they had a hard time expanding, that oil and gas sector has been very good in terms of free cash flow and returning money to shareholders through dividends and share repurchases. Probably the
So that's a
company that scares me the most. Oh, if you want to talk about that.
well. I was just simply going to point out we were just saying that there are companies that have better than 10% free cash flow yield. This is one of them.
Yeah.
Um, full year this year. Well, let's just look out to next year's numbers. We'll call it 1.1 billion on a 12.5 billion dollar enterprise value and a 5.6 billion dollar market cap.
Yeah.
So that's 10% free cash flow on the enterprise value. There's a lot of this is about 50-50 debt to equity, maybe a little bit more debt than equity. But
So
yeah.
that looks good. The company that
Mm-hmm.
scares me the most right now is Apple, because if you strip out their services business, the Apple Store. I mean,
Mm-hmm.
not the App Store. All their product is made overseas,
Yeah.
and then it's exported here, and we buy it here in the U.S. So I've always thought for the past couple of years I've thought their stock was too expensive. For one, because it's not really growing top line. There's a little change in their mix that they're becoming a little less hardware, a little bit more services, and services get a higher multiple. But even with that, it seems to me they're a bit on they're on a little bit more than a bit on the expensive side. I think they should be in more like 20 times earnings as opposed to 28 or 30 where they are now. Um,
So yeah, what's interesting is that on this front, first of all, this is a company that's managed to make their iPhones. I haven't bought a new one in a long time. This is an iPhone 12 Pro, Max Pro. I don't know what that is, but it was the top of the line, and got it with a lot of memory at the time that I bought it. I've thought once or twice about replacing it. Um, and the question I've often wondered is, when do consumers balk? When do consumers say, "I was willing to pay 800 for a phone, but not 1,000. I was willing to pay 1,000, but not 1,200." But there's a big difference between paying $1,200 for a phone paid out over 3 years, um, and getting a step change where they say, the new price is 2,000 actually. We have some tariffs, so the price is now $2,000. That's a whole different thing.
yeah,
And this is a risk that the company faces that I think needs to be acknowledged.
yeah.
And the thing is, this goes also to the cost. I was watching a talk. You know what the cost of manufacturing an iPhone in China is? What their out the door cost on those
I'm
things is?
gonna guess the cost of building it is somewhere between 50 and $100, and they probably have to pay about $250 for the intellectual property. And so the
So
rest
the number
they
I
could
heard was 10.
$10? Oh,
Yes.
holy,
$10.
that's ridiculous.
So yeah, that's but it was actually less than 10. But yeah, basically the cost of putting the thing together, of assembling the phone, was less than 10.
Yeah, well, I
Now I
guess
don't
that's why they're a
know.
$3 trillion company.
Yeah, but it does say that if you wanted to do that business elsewhere, now actually, I guess a part of the question is, how does the tariff get charged on a good sold by a U.S. company that's assembled abroad? In other words, if their cost, including materials and everything else, and shipping it back here, and assembly, all that stuff, let's say that's $250. Do they get charged 20% plus the new 34% makes 54% on the 250? Or do they get charged based on the value of its sale here?
I
That's a
don't know.
big, big difference, right? So that would be, so if they were paying 20%, the increase was 34%. So that, let's say that that was $250 all in, including materials and all that's purchased overseas. That's an increase of $85. $85 on an $1,100 iPhone is only an increase of 7.8%.
Yeah, that's the way I thought tariffs worked. If Foxconn sells it to Apple for $250 and that's the landed price inside the US, they would pay a tariff on $250. That's my understanding of the way it works, but I'm not an expert in that space.
If that's what it is, they'll never onshore the manufacture of those phones.
Yeah.
Because that incremental tariff cost, as big as it is, doesn't nearly offset the labor and capex. Right? The cost of building the plants here is no trivial thing.
Yeah, well,
Um,
Foxconn would have to do that. And yeah, you're right. It's the and that's see here is part of that danger of having all your manufacturing overseas, because that
mhm.
expertise was all developed overseas, and they have it, we don't. So
It's
it's
yeah. I mean,
long
I
term,
guess
it's
one of
a
the things.
security issue as far as from that perspective.
I guess what I would love to see is more local manufacturing in general. And what I mean by that is that this is not, if I was thinking about global trade and what a good situation might look like, it is not only that I hope we manufacture more of our own goods.
Hmm.
It is that my hope that all countries manufacture more of their own goods for the good of their local
Yeah,
populations, and that we focus our trade on the things that we cannot make, like coffee beans. We can't grow tons of coffee in the United States. We can grow it in Puerto Rico. We can grow it in Hawaii.
yeah.
We consume a lot of coffee. We have to import it, or we got to drink something else. That's
Yeah.
just the way it. That's
But it goes
um,
back to my earlier point that a lot of that labor cost will get driven down as it goes to robotics. And the question is do you want to have that infrastructure here in the US or do you want it overseas? These are hard questions that, uh, in a world where if we were all peace, love, and understanding, then we wouldn't really care that much because there wouldn't be national security issues. But there are, and they need to be thought of. And at least we're talking about them right now.
it is a
Maybe we're
really
not
good
doing it in
question
the
for you.
best way, but at least we're talking about them. But where for decades people in the Midwest just complained, they closed my factory again. Um,
Well, the other thing is, I think people forget that a lot of innovation in the United States took place because of manufacturing.
yeah,
And that is that if you had distributed manufacturing, every place there was a plant, there would be people who were looking to figure out a better way to do things.
hmm
It is the natural order of making stuff.
yeah,
People who make things always try to figure out a better way to do it. If we distribute that, the chances are good that we will have better and more rapid advancement for mankind generally. But distributed brings me to another question, which is perfect for you, which is Monday Morning Quarterback is asking, and I can't believe we didn't talk about this. Bitcoin no longer he says actually Bitcoin is not acting like a risk asset, maybe maturing into a safe haven. I would say if to the degree that it is not, it is no longer because it was absolutely behaving like a risk asset at
yeah.
first. What do you think? Are we getting
Um,
to a place where we can start
but
buying some of this?
That's
Look at this;
interesting
it's leveled in the
because
last month.
it was down this morning. It was up a little bit, then it was down a little bit, and then just before we
Now
came
it's
on, it
up.
was up a fair amount,
Mm-hmm.
and looking like a heck of a stick save. And so I think people, if you're looking for a haven without that's not subject to a tariff, it doesn't have counterparty risk. It may be a place to go. I tend to. Um, the reason why they say it's a risk asset is because sometimes it correlates with the market. Market's up, it goes up, market's down, it goes down. And
Mm.
sometimes it goes the other way. But if you look at, correlations in general, correlations are generally not very stable. You look at the
Mm-hmm.
correlation between 10-year bonds and the equity markets, go back, 100 years, the correlation can be as high as zero point 0.6 and as low as minus zero point 0.6, depending upon what's driving the rates and how that's affecting companies. Is the higher rate due to um, um, faster economic growth, so rates are going up and bonds going down and then stocks going up? Well, then they're going to be negatively correlated. But if it's having to do more with inflation, then bonds are going down, stocks are going down.
Yeah.
They look like they have a real strong correlation. Um, so I'm not really sure how to think of that, but I think over time it's going to be a low correlated asset with stocks and bonds.
Yeah, it's well, what's interesting also is that somebody was pointing out recently that the 60/40 portfolio, and when they ever somebody says 60/40, they're really talking about a mixture of stocks and bonds.
Yep.
And actually it's very funny. I saw Howard Marks. Howard Marks was on earlier. He's a founder of Oaktree. Um, and he said, nobody ever called it fixed income when I got into this business. Nobody ever called it credit. He's like, they're always renaming things. He said, it was bonds. When I got into the business, it was bonds, but it's all the same stuff.
Yeah.
Right? So saying first it was bonds, then it was fixed income, now it's credit. But the interesting thing was, of course, in 2022, bonds and stocks became positively correlated because interest rates were rising. That's what was causing the equities to draw down. And of course, if rates are going up, then bonds are going down. But this time, not so much. What do you think about high yield spreads here?
Well, we talked about that in earlier shows, and I don't like high yield bonds. I think the spreads are way too tight. I think that shows lots of complacency. It's people putting risk aside to stretch for yield. And so I'm not a fan, but of high yield bonds. On the plus side, they're not enormously interest rate sensitive because most high yield bonds are issued with maturities of 5 to 7 years. So they don't have a lot of duration. They don't have a lot of interest rate risk, but they do have that credit risk. And if the economy turns down, then we're going to see more defaults and some stress in that area. So, but my view is that I just go back, look at historical credit spreads. They're at the lows. That's not where I want to be owning them, and so it's not my favorite asset class by any stretch of the imagination. In the fixed income space, I kind of like just short investment grade stuff as we sit around and wait for all of this to pan out to see how all this plays out. That it's entirely possible something breaks. As Warren Buffett always says, is you find out who's swimming without a bathing suit when the tide goes out. Um,
Mm-hmm.
the corollary to that is, that's when you find out when people are playing fast and loose with accounting or anything like that. That all shows up during bear markets.
Oh yeah, that I'm glad you brought this up too. Take a look at these guys. So I'm just using KKR as an example.
Mm-hmm.
But what a high flying sector this has been.
Yeah, since the
Um,
since the COVID lockdown, especially.
yeah. Private equity has just been on an absolute tear. So KKR, one of the well-known private equity firms, I mean, this thing traded down from 42-ish dollars to 160. Let's just say it quadrupled in price effectively from the late 2022 lows up through the highs of this year. And it's been cut almost in half since then.
Yeah.
What do you think is going on here? Are you concerned about? Are you concerned about
Well,
the private equity space,
yeah,
and not just the companies that do it, but the private equity valuations? Because if you look at how they mark their books, it's like the stairs up. They never have a markdown.
yeah. Oh, heaven forbid. That could affect year-end bonuses. What the heresy? Um, what I think is happening is that's a really levered play on credit. These guys take companies private. They use 80% debt, 20% equity. They try to even use less equity if they can. But if those companies get into any kind of trouble, they're not going to make their profits. They're not going to get the profits from the carried interest. They're not going to get their fees from the carried interest because they're getting a percent of the gains of the underlying assets as a fee. So if that disappears, then the cash flows to KKR disappear as well. And I think what we're seeing here is when times are good, man, the price of assets go up. They get their 20% of that, and the stocks scream higher. But if the world turns, all of a sudden there's no capital gains anymore, then their revenue disappears. They have to live on their 2% base fee.
I would also encourage folks who are to take a look at this. This just happens to be the heat map from Unusual Whales, but take a look at what's doing well today and what isn't. And the thing I like about looking at a picture like this is you start to see little bits of thematic stuff popping out when you look at it. So if you look over here, you got consumer defensive names. We see Coke, we see Pepsi, we see Procter and Gamble. We see cigarettes in the form of Philip Morris, chips and whatnot, Mondelez. Up here, what do we see? Lilly, J&J, AbbVie, Amgen, Bristol. Merck is obviously not doing particularly
there's
well.
There's a very sarcastic way of thinking about this. So we're in pain. So what do? You run to comfort food. So you're tossing down some Oreo cookies, and then you self-medicate with some products from the drug companies. And I would guess Constellation Brands is probably doing okay. Quick run to the liquor store.
Yeah. So, that's actually a good point. So Brown-Forman.
Yeah.
Brown-Forman, and for those who don't know, that's the maker of Jack Daniels. Brown-Forman was another name that has recently caught a bid, trading about 17 times.
Yeah,
so
not bad.
It's not a growth stock, but it's not bad. And that's not a bad. Look, here's another way to think about it. It's the way I think about it, which is sometimes you have a choppy market. I don't know about Cava, right? So we were asked about Cava. Cava is a very fast-growing business. It's a very well-managed business, and we all really like the idea that we get the next big growth stock. But sometimes it's not a bad thing to buy a company that we know is going. I mean, the same family has been making and selling Jack Daniels for 100 years. It wasn't publicly traded that whole time, but that's basically what you're dealing with there. So the company is going to, it's trading 16, 17 times earnings, and it's going to grow at about the pace of the economy. It's not a growth stock, but it's not a bad placeholder either. Right?
Can we pull up the chart that I sent in about the triple Qs?
Oh yeah, let's have a lock at the tech sector.
Now, I sent this one because I wanted to do a little homage to Guy Adami, my second favorite guy on Fast Money, or a contributor, because he loves these kind of setups. And here, we talk lots about the fundamentals in these conversations that we have. But this is something that Guy loves to do all the time. So he's looking for a trend. He looks for the trend to be broken. And then he looks for a little rebound to the underside of that trend line. And that's where he likes to put on his short. And the reverse, if it's going down, he puts on a long. So this is something that we recommended or talked about on the Options Edge a little over a week ago. And I talked about if really the shit hits the fan, we'll go back to, what is that, 2023 lows, which seems like, oh, that's not too long ago, but that's a lot of points.
Yeah.
a big percentage loss. So I don't know that will happen. Um, but who knows? And so I wanted to do a little shout out to Guy to when I saw this, that, he reminded me that this is a nice trader setup because your stop loss is short. You look for the stop loss to be about 1% above the blue line. And so if that means it was a false breakdown, we're going back to new highs and you step out. So, there's a lot of different ways for traders to skin a cat. You can use fundamentals, you can use technicals, and you got to go with what works for you.
Yeah, actually, that brings up another point as far as the options edge is concerned, because I often publish to it. I wrote an article, and actually, I was talking to you earlier today. I don't know if that one made it onto the Options Edge website or if it was on CNBC Pro. I wrote it Wednesday after I got finished up the live stream, had an opportunity to review what was going on a little bit more. And Brian Stutland had made the point after the close. I shared his sentiment at the time, by the way. We were like, why is the VIX only up 1.5?
Yeah.
It didn't make any sense. So the article said, SPY buy a 550, 500 put spread. That gives you a sense of where SPY was at the time, because it's obviously much, much lower now. And my logic for that was that I said, look, I think the market's going to go lower. And I also think that Vol's going to catch a bid here. Vol's not going to come in. This is not a one and done kind of a thing. People are going to wait to see how this plays out. They're going to see how other countries respond.
Mm-hmm.
If you followed that advice, so if one of these viewers are watching that, you should adjust the spread now, though. Okay, so
Yeah.
because we're actually now approaching the downside strike that I had targeted. I can't believe it. It's not 48 hours later. I wrote that article at about 6 p.m. local time, so 9 p.m. Eastern time, Wednesday night. And here we are, 36 hours later or whatever it is, after that thing, got published. And
where's VIX trading right now, Mike?
VIX is 43.5.
43
It's more
and a
than
half.
double.
So this is, I made this mention. A lot of times, people like to trade this SVXY, which is short VIX. It's kind of a carry trade. How does that chart look right now?
Let's take a look.
And I was wondering your opinion if you think we're getting close to a bottom, if that's a ETF you might want to get a little exposure to.
Actually, I'm really glad you brought this up, because I was asked by at least two different groups today, and including CNBC, by the way, how do I hedge it here? And my response was, wow, I mean, you're coming to me now? I mean, even when we were writing articles and talking about it on the live stream, I agree that you don't want to be long premium. My suggestion as a hedging mechanism now would be anything where you're short more options than you're long. I was, for example, looking at 90-day put spread collars where you're actually short more calls than you're long the underlying stock. All right? So let me construct that really quickly so people can know what it is I'm talking about. I think this is kind of important. I'll just do this one quickly, I guess, in options play. I think that's the easiest way to just pull this up really quickly. The logic here is that we are not going to recover to back to all-time highs anytime soon. Okay, I feel reasonably confident in saying that. However, I will also say, and I think I also believe we're going to get to a formal bear market in the S&P. So a formal bear market requires that we drop about another 5%-ish, give or take.
Yeah, I just saw over here at CNBC, they're saying the Dow is down 2,000 points now.
Yeah, so I would say that, let me blow this out. And if you're trying to get short vol, you need some Vega, and to get Vega, you go further out in time.
Yeah.
But you also need to give yourself big buffers, because we're going to get higher volatility. Make no mistake. I mean, we're not going back to 14 realized or 12 realized anytime soon.
Yeah.
Even if we get good news over the weekend. That's not the way this is going to work. So what does that mean? Well, first of all, if anybody followed my advice and put that 550, 500 put spread on, you got either at the very least take profits and roll down if you don't have time to do anything else. And I can understand because there's 45 minutes remaining today. But what I would say is, if you're buying downside protection, you do not want to buy downside protection because you are concerned right now about the next 2.5%. We're going to get 2.5% moves each day.
Yeah.
So 2.5% move is a nothing burger. Don't focus on that. What you're more interested in is, are we going to revert to long-term mean forward valuations, which is a decline by my work of about 13% from here? So I'm saying 5 to 13%, right? That seems very like a realistic downside possibility. Well, at least 5 is down to 475, and 13% is, going to be well below, you're going to be down around like 435, 4350 in the S&P, right? So 4350-ish, 435 in SPY. So that's really the range you should be thinking about. So you could do something like a 480, 430 put spread, something like that, as your downside piece. And then if you're going to sell calls, normally we would say, well, just trade something where you can get close to zero cost outlay for a trade like that. But I'm not in favor of that because I don't want to sell that kind of near upside because, this is a rapidly changing situation. And if you own stocks, you don't want to get called out of it, well below your point of entry if you bought recently or where the stocks were even just recently. So what I would instead suggest is choose a strike where you have greater conviction that real resistance will be felt. And maybe lay out a little bit of premium. A little bit of premium is okay. But let me give you an example. So this, if you sold 2 575 calls to buy the 480, 430 put spread, right? Well, that's substantially higher than we are right now, right? So we're around, we'll call it 510, but that's up 13% from here, okay? And the important thing to remember is that if you have long stock, that's not even your break even. That's not even where you're necessarily, you're going to necessarily lose money because you're going to make money on the stock coming back, right? So I would say to folks, these are the kinds of strategies, because a couple things can happen. We can go lower. I expect we probably will, unless we get some good news over the weekend. And to your point, I don't really see Trump backing down now. He may eventually, but probably not right now. So when you look at all of this and put it all together, I think the chances of getting back to all-time highs within the next couple of months are virtually nil at this point. Virtually nil.
I'd agree. There's
First
a
of all,
washout coming. There's a good washout underway.
Yeah, besides which, I think people should remember this. It's not like stocks were super fairly priced at those highs. They became a lot more fairly priced as declines took place, but they were not cheap by any means. So you would have to take away all of the bad stuff for investors to say, you know what we should do? We should pay above average valuations for stocks now. That's what we should do. Let's pay 20% premium to where they've historically traded. This is it. That's not going to happen.
Not good.
And I don't usually speak with a whole lot of conviction, but I think I can speak pretty confidently on that point.
I hear you.
And with that, I know you have, I was about to say patients to see, doctor, but of course your patients are your students. My son actually had a math test coming up, and he was, my wife said, why don't you ask me for help? And he's like, he doesn't know anything about the way we're learning math, these days. And I said, that's actually probably true. I probably don't. But let me at least see the kinds of problems you're working on. And the first problem I saw started like this. Imagine you have $8,500 that can earn 5.4% annually compounded quarterly. And I said, you didn't think a question like that was the kind of question you could come to me about? I was like...
That's funny.
I said, there's a lot of things they could be asking you in school But that's one where you can ask me.
Yeah.
I think I can help you here.
Yeah, that's funny. That is
Oh my goodness. Well, I hope you have a great weekend. This is, not
too.
been as trade focused. Oh, Tucker D Dog was saying Nvidia 2 is all manufactured offshore. Yeah.
Yeah,
I would like to see manufacturing built here. I would like to see regional manufacturing in many cases. I think it's wise, and I think it's better for mankind because I think we'll get better innovation this way. And none of us want to be overly dependent on other countries because it leads us to this place we find ourselves in right now. A global trade war has the possibility to conflagrate into something greater.
yeah,
And we've got enough of that already. Russia,
yeah.
Ukraine,
Got too much.
we don't need China going into Taiwan, but I think who knows, they might. So anyway, there will be opportunities to buy very good companies, I believe, at good prices and soon. That's what I believe. So if anybody wants to go to turn this off, or if you're watching a replay of this to think about over the weekend, that's it. What are your final thoughts for everybody?
Well, caution is the name of the game here. So, I had been bears for a while. You got to let this one play out, and I think I've been just the way the market's trading now. I'm guess it's going to be down all of the month of all of this month. People are going to have another a shock, right? Because you got to pay your income tax.
Oh yeah, that's right.
If you had your money sitting in the stock market hoping that it was going to help you pay your income tax, you're in trouble.
Right.
But just let it play out, and don't feel the need to jump too fast to buy the dip.
Sound words, wise advice.
Okay.
All right, everybody, like, subscribe, notification bell. Thanks for watching, and be sure to tune in and see us next week. Thanks for watching.
Bye, everybody.